What's up everyone, Stan here from FundingTraders.com. In this video I'm going to show you and explain to you how I passed the $2 million challenge in 2 phases, and I'm going to show you the difference between institutional type of trading and thinking versus retail. I don't think a lot of videos on the internet actually make this distinction and give you key differences as to how big players look at the markets versus how retail players look at the market, and my trading will show you exactly how I've achieved basically passing $2 million challenge with no losses, meaning I pretty much had 99% of accuracy, and I will explain to you how I've achieved that over the span of 4 months. But this is the difference between institutional, one of the key differences between institutional and retail traders. We're patient and disciplined. We're not in a rush, unlike people who are trying to turn their $1,000 into $2 quadrillion, right? So let's jump right in. As you can see here, these are the scrolls on the screen where you can see all my trades. I passed the $2 million challenge in 2 phases. I prefer 2 phase versus 1 phase account challenges, and this is what I actually recommend for more novice traders because it's a little more lenient. Yes, it takes you a little longer, but the rules are better in your favor and can benefit you, stopping you from being too aggressive and give you a little more leniency, so to speak. I recommend, at least for the first timers, to use the 2-step challenge and not to be greedy. So how did I achieve passing all these trades without taking pretty much any stop losses? Well, the reason why I've been able to do that is because you have to understand, from institutional point of view, you have to look at the instruments and gauge their volatility. Problem is with retail traders, they all are so myopic and so zoomed in, they don't even realize what they're doing at the end of the day. I'll give you an example. Let's say your euro dollar is trading 1-to-1 at parity, right? And then euro dollar goes from parity 1.00 to 1.05, which is 500 pips. In the world of a forex trader on a retail floor, 500 pips is probably 5 blown accounts at the end of the day, right? What is the average distance of a retail trader's stop loss? Usually 30 pips, 20 pips, 10 pips, the sniper entry, all that nonsense. But in reality, if you think about it, euro goes from costing $1 to $0.05, which is 5 cent difference. 5 fucking cents. Do you realize it's only 5 cents? 5 cents, which is 5% move. 5% move ain't shit. Ain't shit in reality. It's only a lot of big deal when you are over leveraged. Everybody says don't use so much leverage, don't trade too big, too everything, right? Too myopically zoomed in on a 1-minute chart and trading all that jazz back and forth, back and forth, back and forth. When in reality, the whole move was only 5 cents, right? 5%. So the 5% move, if you're trading zoomed out on higher time frames and using small leverage and small position sizing, you can pretty much get out of your positions even when you're wrong at break even. And most of the time, you will achieve some profitability. Why? Well, because if you actually understand where institutional flow, meaning all the big players, where they're pushing the price toward from the daily, weekly charts, and there's a little blimp, let's say the euro dollar is going from 120 to parity, and in between that move, there are some back and forth, which is the volatility itself. You can withstand the volatility when it goes against you, because if you start with a small enough position size and nothing major fundamentally changes in the picture, you can withstand that heat. You can withstand the heat of 100 pips or 150 pips during the 2-day pullback, and then it resumes the move into the direction of the trend. Now, same scenario on the 1-minute chart. Now the trade goes against you 50 pips, 75 pips, 100 pips. You're panicking because you're trading on a 1-minute chart. You're trading on a 5-minute chart, right? When I'm trading my instruments with a small position size where I'm risking 0.1%, I understand it's a $2 million account, but you can apply the same thing and do the same thing on a $100,000 account or $200,000 account, which are available on any prop firm, including ours. You can easily do the same performance just starting small. So understand one major thing, that currencies are designed by design for stability, because if one currency is going to move 30-40% a day, like Bitcoin for example, then imagine you're a Toyota corporation, you sold a bunch of cars in a month of October, and then you're repatriating the money back to Japan, so you have to convert dollars. You were selling the car, your Toyotas, in United States, and then you have to convert it back to yens to bring it back to Japan. If in that span of 1 month span, the currency lost 20, 30, 40% of its value, your conversion rate is asinine, right? You will never make profit if there is no stability in currencies. So by design, the volatility of these instruments called currencies are not designed to be super volatile. They only appear super volatile when you are over leveraged. And that's when you're trading on these 1 minute charts and 5 minute charts, which you can do if you know what you're doing. But in this particular example, I'm just showing you how pretty much took no losses and passed the challenge. Yes, it took me 4 months since June, but so be it, no big deal. Right? Point being, if you actually are patient and you understand that the currencies are designed not to be volatile, and you understand where the major flow is going at daily, weekly, where institutional players are pushing markets towards, what is Federal Reserve doing, what is ECB doing, what is Bank of Japan doing, etc., 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 what's happening with the bond markets, what's happening with the rates, and how it affects all the currency flows, etc., etc. Once you understand all these basic macroeconomics principles, and then you use technical analysis from daily, weekly charts, and then use 4-hour time frame, you can pretty much not take any loss, or at least get out at break even 90% of the time. Once in a while you'll have to take a loss because something major will happen and the trend will turn around and will go the other way. There's no such thing as no losses whatsoever, but at least you will not be stopped out like a dickhead on every time there's one day it goes up, another day it goes down, and all it did was 50 pips that way, 70 pips that way, and you've done 20 fucking trades, you've generated zero profit, lots of headache, all that action, you're all excited like you're in a casino. At the end of the day, and all you have to show for it is 20 blown accounts. So not to be a tool for brokerages. And this is, by the way, all this retail nonsense with the stop losses and everything, it's mostly been taught by brokerages for you to trade on 1 minute charts so you can generate fees for them. You understand? Brokerages, they don't care if you're going up or down. They just need you to generate commissions and pay these spreads. That's how they make money, most of them. So they need you to generate. If I take one trade a week and I sit in it for a week, I'm not a very good customer for them because I only pay commission once for that one trade to get in, to get out at the end of the week, and that's it. That's why it took me 4 months to pass the challenge. Meanwhile, somebody took, in that same week, they took 40 trades, and then, what do they have to show for it, right? So if you actually zoom out and understand the brokerages are the ones to tell, oh, you have to put a 10 pip stop there, there's this level here, blah, 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 all the jazz. It's nonsense. No, you don't have to do that. Understand the basic volatility, monthly volatility of an instrument, daily volatility of the instrument, and stay out these volatility zones. If you actually apply basic mathematics and statistics, you don't need to be part of the 90% who are inside of that zone that are just getting chopped up and killed on a short-term time frame. Understand where the major flow is going and go with that flow, and just stay outside these zones of volatility for daily and hourly and 4-hourly volatilities. Okay, stay out of it. Understand where it's going, and again, you're not gonna be able to do it first year on the job. You're 16 years old, you just got your driver's license, and I'm showing you what an F1 pilot can do. Obviously, you still have some work to do to get to this level, but this is how it's done. You basically have to understand, with a small enough position size, you don't have to, first of all, you don't have to sweat, you're not worried, you understand that the volatility of a particular instrument, particular currency is this much. It's not designed to go up and down 20-30%. You just have to stay out of that volatility. And if you gauge the market correctly, yeah, your P&L will float. It's gonna go up and down within a day or two, but within a week's time, if you're staying in a position for a week or two, it will go in the direction of the major flow if you're correct with your analysis, and you will at least either get out or break even when it's really bad situation and something happened. Most of the time you will make profit, and that's how what you're gonna see on a lot of the trades that I'm showing on both of these accounts. Some of them have very little profit. That's when I was getting out of break even pretty much. Some of them I made 20, 30, 40K, 15K, 10K per trade, right? So this is how you do it. You understand that, first of all, currencies are not designed to be volatile. They only appear volatile when you are so myopic in your trading that you're so zoomed in on a 1 minute chart with 100x leverage and your position size is so big that 2 pip move causes panic, when in reality, like I said, a 500 pip move sounds a lot, but it's only 5 cents in reality. What is 5 cents? You can't even buy chewing gum no more for 5 cents, right? So once you understand that and you can account for it with the position sizing, which is correct, and you don't over leverage and you become disciplined and not greedy, and you can stay focused for a prolonged period of time and just go with the flow of the institutional players, you will succeed and you can replicate this result. So if you want to give it a try, my door is always open at FundingTraders.com. I can explain to you in detail. Ask me any question. I'm on Discord, I'm on Telegram every day talking about all this. Stop by, check it out, give it a try yourself. Zoom out, go on higher time frames, and be patient. Be patient. I know I was young too at some point. I was very impatient as a young man, but this is how you learn. You get beaten like a rented mule. I say it all the time. And that's how markets teach you how to become patient. And this is a perfect example how after 20 years of being beaten, and beaten. This is what's possible, and I'm not saying you should replicate it or you shouldn't take stop losses, but this is a possibility. I'm just showing you what's possible when you're an F1 pilot. FundingTraders.com.